2 months ago on this channel, I made this YouTube video down here exposing how I made $70,000 in 6 months day trading. And in this video, I broke down exactly the strategy and system that I used to reach to $70,000 in such a little time period, right? And in this video, I'm going to be showing you the exact same strategy. The only difference is that I've now made $147,000 in 8 months trading. In this video, I'm going to be showing you how I turned data into profits, how I turned all this into $147,000 right here. This is a screenshot from my bank balance, right? This is a 365-day sort of period. Obviously, I only started making money on this account around October. It is a complete trading account for tax purposes because I am in Australia, so it just works differently than most US sort of tax rules or whatever the case may be, right? So I made a separate account strictly for business and strictly for trading profits. And as you can see, $147,000 in there. I also have it up on my phone so that you guys can see that is not a complete screenshot and Photoshop. You can see it is my realized thing right there, all right, showing you exactly right that it is real. I've made $147,000 in profits in literally just 8 months trading. Let's break it down. How can we achieve, right? How can we achieve this? What is this, first of all? Well, this is a win rate. This is my win rate using the system I'm going to be breaking down for you today. 94.7% in the month of May. Now, win rates vary over different months, all right? Win rates will vary for every strategy over every different month. Now, in May, it's 94%, almost 95%. So how can we trade at such a high win rate? All right, how can we manage this? What are we doing? Well, let's break it down. A lot of traders focus on super high risk to rewards. And you're probably one of those traders too, right? You're probably someone that goes for a 1 to 3, 1 to 4, 1 to 5 risk to reward. I did all this. I made $147,000 with only a 1-to-1 risk to reward. So how am I able to make so much more money than most of these people going for 1 to 4, 1 to 5, 1 to 6 risk to rewards? See, in the future space, you can either trade with personal capital or you have the advantage to trade with prop firms. Now, this strategy was built and designed to strictly beat the prop firm system. Get rid of all their rules and obviously work and play around their rules. They have super strict rules that make traders lose, all right? That's just the way prop firms need to make money. So they make the rules really, really tight and difficult to obviously pass. Now, this strategy follows a strict system where it's almost near impossible to not pass an account the right way and to not get a payout. It's because it's designed in a way that's going to get you to where you need to get to in terms of outcome. See, by targeting these 1-to-1 risk to rewards, right, we can understand that we're going to trade at a higher probability and more frequent. So let's look at prop firms real quick. Right? I know it's a little blurry. There is a lot of trades on here, so I can't fit the whole screenshot on here on the screen, but let's break it down real quick. Prop firms, what do they chase? They want consistently profitable traders, right? Let's talk about consistency. What is more consistent? A 1 to 4, 1 to 5 risk to reward, or a 1 to 1, or even a 1 to 2 risk to reward? Obviously, it's going to be a 1 to 1, 1 to 2. Now let's talk about frequency, trade frequency. See, most of these prop firms run at a minimum trading days. You're going to have a minimum trading days in order to request a payout. It could be 5, it could be 8, it doesn't matter, right? Most of these firms have that. So you can't just request a payout on day one, unless you trade with Take Profit Trader, which is something that I use, we'll get into later on. Now, these firms have minimum trading days, which basically really just forces traders to actually place a trade or want to place a trade or have the need to place a trade every single day. And not every day is going to be a trading day. And that's the reality. Not every day is going to be a trading day where you take a trade. But that's where traders get trapped. They force it to obviously try and get a payout in as little time as possible in the minimum trading days, right? And that's where traders go wrong. Looking for these 1 to 4, 1 to 5s, which is not going to be very frequent in terms of an everyday sort of setup, right? That's where they lose. But a 1 to 1 is going to be very frequent. You can see on days over here, right? On days like this, on May 1st, I took 3 trades. May 2, I took 3 trades. May 5th, 4 trades even, right? You can see that's very, very frequent. And when I look at something like this, right, this goes hand in hand, right? It's got the consistent part of what prop firms look for. Remember, they look for consistency and they look for consistently profitable traders, right? So we've ticked off, okay, 1-to-1 is going to be more frequent and more consistent. Now, how do we get the profitable? Well, guess what, right? In terms of profitability, right, a 1-to-1 is going to be more frequent and higher probability, right? Because you're not targeting 1-to-4s, you're targeting 1-to-1s. And before you even get to a 1-to-2, 1-to-3 risk to reward, you're always going to surpass a 1-to-1 risk to reward, which means it's going to be higher probability at a lower risk to reward. All right, so now that we understand, okay, cool, higher probability, does that mean a higher win rate? Yes, it does. When you win more though, right, what does that do for your psychology? When you win more, you get more confident. When you get more confident, you can apply more risk, right? And you can take trades without hesitation. You can build strong intuition around your trading. So you notice a pattern now that's starting to form, all right? Okay, cool. We can tick off that this is going to be more profitable than a 1-to-1. Over a long period of time, a 1-to-1 risk to reward trader is always most likely going to surpass someone that's always hunting an everyday setup for a 1-to-4, 1-to-5 risk reward. Does that mean you need to stop targeting these high risk rewards? No. It just means obviously on days where price action is not likely to give you the 1-to-4, 1-to-5, that you can obviously walk away content with a 1-to-1 risk to reward. So you can see here from the data, I've marked out and dotted all the fair value gap continuation, which is the strategy I'm going to be breaking down today. It is my fair value gap continuation model, right? That trades at, again, 94% win rate in the month of May. So right here, you can see, right, 1-to-1 risk rewards on every single trade. Now, all the fair value gap continuations, I'm not going to show you this setup in today's video. I'll leave that for another video. That is my reversal model, but we're going to be focusing on my continuation model, all right? Which is another thing, being super versatile in terms of strategy, not just sticking to one. If you're like a scalper like me, or if you're a scalper in general, might as well have a reversal and a continuation model. Keeps you versatile in the market. But right here, you can see win, 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 win. We took one loss down here. Let me try and find it. We took one loss down here, which even then, just focusing on this, like my entire data using my other system got me 94% win rate. But again, if you just focus on that, it is win, 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 win with one loss. That's a 90% win rate out of the amount of trades that I took. So now let's cover a bullish example on how we're going to use the setup. Like, what is the setup that we're going to be showing on the charts? Well, this is a bullish example. So this is all we need to do. We need to identify a fair value gap, a pull back into the fair value gap, and then our entry signal. So if you don't know what a fair value gap it is, I break it down on this channel all the time, but I will refresh your memory for those who are new to somewhat of trading. It is a 3-candle formation, not 2 candles, not 4, but 3. So 1, 2, 3 upwards closed candles. It can either be, a couple downwards closed candles, doesn't matter, right? It's 3 candles, and all you're identifying is if the first candle is high. Let me get rid of the box, right? The first candle's high meets or overlaps with the third candle's low. So you can see in this one right here, it does not, right? It does not meet or overlap with the third candle's low on the first candle's high, right? So this leaves a fair value gap. All right, and I've drawn it out with a little rectangle box. All we need to identify is where price stops, right here, and mark that out and pulls back into this. Once we pull back into that, we have this level marked out. So step number 1 is identify the fair value gap. Step number 2 is mark that level out. Step number 3 is obviously wait for price to pull into the gap. Now we want it to respect the gap. We do not want it to body close below, right? We want it to obviously stay above, right? It can wick below, it's fine, but not a body closure below. And then all we're doing for step number 4 is we're going to mark out our previous candle high, our most previous candle, right? And we're going to wait for step number 5, a candle closure above previous candle high. It is that simple. There is one simple rule that we have to follow though. We do not want the candle closure that we're looking for. We want this candle to close, our current candle, to close above previous candle high. We do not want it to make equal highs or sweep the swing point before closing, right? If it does that, it lowers the probability of the setup. But again, right, it's still a valid setup in this standpoint for what I'll be showing you, focusing on a 1-to-1 risk to reward. Now, again, right here, candle closure, I'm taking my entry here and I'm targeting a 1-to-1 risk to reward. But where am I putting my stop loss? Well, most likely this candle is going to have a wick like this. So you have a couple different options. You can be super aggressive and put your stop loss underneath here. You can put it underneath the lowest candle that came into the fair value gap in respect to the fair value gap, or you can put it directly underneath the fair value gap, right? Because obviously we should not be disrespecting that gap, right? Now, wherever you put your stop loss, you have to match it in a 1-to-1 risk to reward. That is how you get the high percentage win rate. So now we have a bearish example. So again, step number 1, what are we doing? Identifying a bearish fair value gap. 1, 2, 3 candles. You can see the first candle is low, does not meet or overlap with the third candle's high. This leaves a fair value gap in this little box, right? So we're going to mark that out just like that. Then step number 2 is we're going to mark out the swing point when price starts to pull up into that, right? Into that fair value gap. That's step number 2. Step number 3, we're going to wait for price to pull into this fair value gap. Step number 4, we're going to be marking out a previous candle low. And step number 5, we're going to wait until price closes below previous candle low right here. Again, not making equal lows or sweeping the sell side swing point right there. All right, if you have all those ticked off, you can take an entry. Again, most likely it's going to have a wick here. You can take a stop loss position up here, right above the highest point of the candle that came into the fair value gap, or above the fair value gap, focusing on a 1-to-1 risk to reward. So wherever you put your stop loss, you have to target that in a take profit. It is that simple. So these were all the setups that presented yesterday. Now, I trade this setup mostly on the 30-second time frame. Very simple. It's not fast. It's not fast paced. It's super easy. Even a real beginner can actually do it. Most people that are trading, whether it's ICT concepts or anything in general, mostly trade from the 1 to 5 minute. All right, that's just kind of the principle here. Now I trade my model right here, my fair value gap continuation model, from 9:30 a.m. up until about 11 a.m. Eastern Standard Time. That's the only time I really trade this, because obviously the volume is very nice. All right, and I like volume. Now, we have a ton of different setups that we're going to be breaking down right here. For this example, we're going to identify a fair value gap, right? This candle came into the fair value gap right here, right? Well, this is the swing point. So we've marked out step number 1, which is the fair value gap. Step number 2 is going to be mark out the swing point, right? Step number 3, we're going to wait for price to pull into it. That's number 4 is right here. Next, number 4 is we're going to mark out previous candle low, wait for a closure. Nope. Next one, closure, nope. Next one, closure, nope. Next one, closure, yes, we finally get one. On this candle, what happens? Boom, we get a candle closure right here on this candle, right? We did not make equal lows or sweep this swing point, so we can take our entry there. Again, you can be super aggressive and put your stop loss above here. Now that doesn't really seem reasonable. You can put it above the highest price right here, or anywhere above the fair value gap. Now right here, I decided to just go above the fair value gap at around 15 points would have been fine. Okay, and then we target 15 points in itself right there. Now, with this setup, you have the option to target more than a 1-to-1 risk to reward. In fact, you can target the whole thing down here if you really want to. Right? As you probably know from one of my last YouTube videos, I said on days like this, where price just runs with no real structure to the upside or any reversal model opportunities, right? It trades at a 91% win rate in terms of opportunities and how many trades you can actually take. All right. Now, if you just took one, you could be 100% win rate, but I showed 4, right? In terms of all the setups that presented themselves today, 100% win rate in terms of what was in session. Right. And again, I made that video not too long ago. I think it was my last YouTube video on this channel. So if you're going to watch that, you can go check that out as well. Right. So about 15 points, targeting 15 points. And there you go. That's price hit. Or you can go for a 1 to 2. That's hit there. Or like I said, you can keep trailing as it goes further and further into your profit. That's completely up to you. Next on, exactly the same thing. Price comes into the fair value gap. That's step number 1. Step number 2, mark out the swing point. Step number 3, mark out the most previous candle, right here, and wait for a candle closure. You can see no candle closure, no closure, no closure, no closure. There, we finally get a closure right here. So we can take our entry there. In terms of a stop loss, we can put it just above the candle high right here. You can put it above the highest point of the swing point or all the way up here. Now, I just put it again, following 15 points. It turned out perfect, literally above that high. And you can follow 15 points as well, targeting down there. You can run it for a 1 to 2. Again, it's all completely up to you and how you want to manage it. I'm just showing you a 1-to-1 risk to reward. Same thing again, fair value gap right here. That's number 1. All right. Now, number 2, you can see that we came and marked the swing point, most previous candle low. Step number 3, all right, coming into the gap. Step number 4, mark out the previous candle low. And now look at step number 5. Step number 5 swept the swing low. So should we take this or should we leave it? Now on days like this, we probably could get away with taking it in terms of a 1-to-1 risk to reward, right? Because price is obviously extremely bearish. And in my last YouTube video, I broke it down again. On days like this, it trades at a very high win rate. Now, you can avoid setups like this. You don't have to take a setup like this. But if you did want to, and we could just put it above the candle's high right here, right, we can focus on a 1-to-1 risk to reward. bang, it hits anyway. So you could grade this at around a B setup. I would grade it at a B setup. I'd give this one an A, and I'd give this one an A+, right? And again, the last setup right here. Now you had a setup here, but it was 2 minutes before news event. So you want to just make sure, I don't usually trade 5 minutes before a news event, right? Obviously in session, you can see that we came back into this fair value gap. We had a previous candle low, right? So obviously that's step number 1, is identify the fair value gap. Step number 2, identify the swing point. Step number 3, wait for price to pull into the fair value gap. Step number 4, closure below previous candle low. And then obviously step number 5, make sure there's no equal lows or equal highs, and just wait for that closure. Boom, stop loss can go above here, 22.50, right? And boom, just like that, or 22.25, 1-to-1 risk reward, or you have the ability to run it for a 1-to-2, completely up to you. And by that time, you should really be done. That was 4 trades just basically before 35 minutes into the session, right? So that is pretty much it in terms of simplicity. I don't really want to break down more of this. You should really grasp an understanding of it already. If this video was helpful for you, obviously you got any value, or you're going to willing to give it a go, maybe back test it, right? Obviously subscribe for more content. The next 4 or 5 videos, I'll be breaking down more about this like strategy in itself. Again, that is it, and I'll see you in the next video.